There's a gold and silver trap being set as we speak, and almost everyone is walking straight into it. What the mainstream media isn't telling you is that this record breaking rally, the one splashing new all time highs across the news, might be designed to do just one thing: take your money. It feels like everyone is telling you to buy gold and silver right now. Your friends, family, the so called experts on TV. But in the next few minutes, I'm going to show you why that could be the single biggest financial mistake you make this year. We're going to pull back the curtain on the mainstream story piece by piece and reveal the anatomy of a perfect bull trap forming right before our eyes. So pay close attention, because what you learn today could be the difference between protecting your wealth and becoming another casualty of market hype. You really can't miss it. Turn on the TV, open a financial website, and the headlines are practically screaming. Gold has pushed into uncharted territory, breaking above the once mythical $4,000 mark. In fact, as of early December 2025, spot gold has been consolidating in a range between $4,100 and $4,200 an ounce, with the 2025 average hovering near $4,080. The narrative being sold is that this is a fundamental repricing of the world's ultimate safe haven asset. They'll tell you that the days of sub $3,000 gold are ancient history. And if the story in gold sounds impressive, they'll tell you to look at silver. Silver, gold's more volatile cousin, has been on an absolute tear. As of early December 2025, the metal is trading in the neighborhood of $50 to $51 an ounce. In doing so, it has finally poked its head above that long standing high of around $50 set way back in April 2011. For more than a decade, that $50 level was a ceiling that seemed unbreakable. Now that it's being tested, the bullish chorus is deafening. They'll point to silver's dramatic rise as undeniable proof that we're in a powerful new precious metals bull market. On the surface, the reason for all this excitement seems perfectly logical. It's a textbook case for owning hard assets. First, there's the stubborn problem of inflation that just won't quit. Even as central bankers talk tough, the rising cost of living keeps eating away at our money's purchasing power, pushing smart investors toward gold's historical stability. Then, you add in the geopolitical chaos. The world seems to be stumbling from one crisis to the next, and with every new conflict, there's a flight to safety. In a world this uncertain, gold is seen as the ultimate store of value. It's the asset you own when you don't trust anything else. But here's the kicker, the proof point for the bulls: the behavior of the smartest money in the room, the world's central banks. For years, they've been on an unprecedented gold buying spree. After purchasing a staggering 1,082 tons in 2022, they continued to stack aggressively through 2023, adding nearly 900 more tons. The trend has remained strong in 2025. These aren't speculators. They are governments methodically de-dollarizing their reserves and swapping them for physical gold. Just look at a country like Poland, which aggressively boosted its reserves to nearly 360 tons by late 2023, signaling it's not done yet. When governments themselves seem to be losing faith in paper money, it's presented as the ultimate seal of approval. To top it all off, big investment banks are issuing wildly bullish forecasts, with some Wall Street analysts projecting gold could climb toward 4,500 or even touch $5,000 an ounce by 2026. So let's recap the story you're being sold: record prices, stubborn inflation, global turmoil, massive central bank buying, and bullish Wall Street targets. It sounds like a can't lose scenario. It's a story so compelling it's drawing in people who've never even thought about precious metals before. And that right there is the most critical part of the trap. What we're seeing has all the classic signs of a bull trap. A bull trap is a false signal, a mirage in the desert that convinces investors a rally will continue forever. In reality, it's often the final, exhaustive gasp of that rally right before a sharp reversal, a trapdoor opening beneath the market. It's designed to prey on one powerful emotion, the fear of missing out, or FOMO. It sucks in the last wave of buyers, what Wall Street unkindly calls the dumb money, at the absolute worst possible time. These latecomers provide the liquidity that the smart money, the early investors, needs to sell their positions for massive profits. The moment the trap springs, the price reverses with shocking speed. The new buyers are immediately underwater. Panic sets in. They bought on hype, and when the hype vanishes, they're left with nothing but fear. They sell at a huge loss just to stop the pain. And who do you think is there to buy back those cheap ounces? The same smart money that sold to them at the top. It's a brutal but incredibly effective way of transferring wealth from the impatient to the patient. You know you're near a peak when your barber or your neighbor, who never talks about finance, starts telling you that you have to buy silver. That's not a buy signal. That is a massive alarm bell telling you a top is near. It means the story is so widespread that there's almost no one left to convince. This is the point of maximum financial risk. And right now, that bell is ringing. The media's blanket coverage and the celebratory headlines are all part of the conditioning. It creates an atmosphere where being cautious feels foolish. This psychological game is what greases the gears of the bull trap. But this isn't just theory. We have a perfect and painful historical parallel. We just need to turn the clock back to 2011. The ghost of 2011 is haunting this market, and the similarities are just too glaring to ignore. In late 2010 and early 2011, the buzz around silver was electric. The world was still recovering from the 2008 crisis. Central banks were printing money, and the story was that silver, the poor man's gold, was destined to catch up. Sound familiar? The price went parabolic. From around $18 in mid 2010, silver went on a breathtaking run. It blew past $30, then $40. The media went into a frenzy. In April 2011, silver touched its peak of nearly $50 an ounce. The euphoria was absolute, and then the trap sprung. In a matter of days, the price collapsed. Margin requirements for trading silver futures were hiked repeatedly by the exchanges, a classic move that forces leveraged traders to sell, which causes more selling. From nearly $50, the price plunged over 30% in less than 2 weeks. The rocket ship had turned into a falling knife. Many retail investors who bought in on leverage near the top were hit with devastating losses. Now, here's a critical detail. While silver was crashing, gold kept climbing for a few more months. The narrative shifted to gold is the real safe haven. Gold peaked later that year in September 2011 near $1,900 an ounce. Then it too rolled over and entered a brutal multi-year bear market with its price falling by around 45% to its low in late 2015. The pattern was clear. First, the more speculative asset, silver, has a euphoric blow-off top and crashes. Then, the senior asset, gold, makes one final push before the entire complex rolls over. Now look at today. We're seeing a similar playbook. A parabolic run in silver, mainstream media fanning the flames, and everyone saying this time is different. But market psychology never changes. The setup is the same, the emotions are the same, and the risk of the outcome being the same is incredibly high. Beyond history, the charts themselves are flashing warning signs. Even as prices push to new highs, key momentum indicators like the Relative Strength Index, RSI, are failing to make new highs alongside them. This is a classic technical pattern called bearish divergence. Imagine a car accelerating while the engine is sputtering and losing power. The price is still moving up, but the energy driving it is fading. It's a textbook signal that the rally is exhausted and vulnerable to a sharp reversal. Finally, we have to talk about something this audience knows all too well: the potential for market manipulation. This isn't just a theory. Regulators have fined major banks for illegal trading tactics in the precious metals markets. One of these is spoofing, where a trader places a huge order with no intention of filling it, tricking others into selling. They then cancel the fake order and buy at the lower price they helped create. Imagine tactics like this creating volatility at a market top, shaking out nervous retail buyers. And then there's the ultimate tool we saw in 2011, margin hikes. The futures exchanges can increase the capital required to hold a position. While they call it risk management, doing this during a parabolic rally creates a forced selling cascade. It's a death sentence for leveraged traders. Let's zoom in on silver, because it's the center of the excitement and the most dangerous part of the trap. The bullish case for silver is incredibly seductive, and to be fair, a lot of it is true. You'll hear about silver's dual role as both money and an essential industrial metal. That's correct. Roughly half of all silver demand comes from industry. It's critical for solar panels, EVs, and 5G tech. The demand from the green energy transition alone is huge. Plus, the mainstream story points to a structural supply-demand deficit, meaning we're using more silver than we're mining. When demand outstrips supply, economics says the price should go up. This is what gives so many people the confidence to buy at any price. Then there's the gold to silver ratio. This is just the price of gold divided by silver's price. With gold around $4,200 and silver around 51, the ratio is sitting near 80 to 1. Historically, the average is closer to 40 to 1 or 60 to 1. The argument is that for the ratio to return to its average, silver's price has to rise much faster than gold's. All of these points are valid. So why do I call it an illusion? Because in the short term, when a panic hits, fundamentals become completely irrelevant. When the trap springs and the price plummets, nobody is thinking about supply deficits or the gold to silver ratio. The only thought in a panicked mind is get me out. The same leverage that created the spectacular rise up becomes an anchor that drags the price down even faster. The long-term fundamental story will still be true after the crash, but very few investors have the stomach to hold through a 40% or 50% loss. The bull trap isn't about disproving silver's long term value, it's about exploiting short term crowd insanity. In fact, the strong fundamental story is what makes the bait so effective. It gives people an intellectual reason to chase the price higher and ignore the warning signs. They feel smart buying it because they can recite facts about solar panels, but they're confusing a long term thesis with a short term trade, and that's a fatal mistake. The big players are more than happy to sell you their silver near the highs because they know there's a good chance they can buy it all back from you at a much lower price in a few months after the panic is over. If you're getting value from this analysis and you want to learn how to think like a professional macro investor, I'm offering Module 1 of the Macro Investing Masterclass for free. Just click the link in the description. This isn't just theory. This is the same framework that the smart money uses to navigate the market. And if you're ready for more no-hype, actionable insights that challenge the mainstream story, hit that subscribe button and the notification bell. It's free, and it helps more people get access to the real analysis that's often missing. Now let's dive into how you can take action today. So what's the bottom line? The story you're being sold about an unstoppable rally is seductive, but it's incredibly dangerous. The current market action, the parabolic run, the public euphoria, the fawning media coverage doesn't signal the start of the real move. It signals the end of a speculative frenzy that looks exactly like a classic bull trap. We've seen this movie before. The ghost of the 2011 peak is a stark reminder of how quickly a rally can turn into a devastating crash. Technical indicators are flashing warnings, and the paper markets are ripe for a volatility event designed to shake out the public. The powerful fundamental story for silver is being used as the bait for the trap because in a panic, fundamentals are thrown out the window. The solution is not to give up on precious metals. It's to have the discipline and patience to not become a victim. It's about waiting for the correction, for the fear, for the blood in the streets. That will be the real generational buying opportunity. I'll leave you with this. The legendary investor Sir John Templeton famously said, "The time of maximum pessimism is the best time to buy." The flip side of that is just as important. The time of maximum optimism is the best time to be cautious. When every headline is screaming buy, it might just be the world's greatest signal to be patient. The trap is set. Don't walk into it. So, if this is a trap, what's the right move? The answer isn't to sell everything and run for the hills. The long-term case for holding precious metals as insurance remains as strong as ever. The solution is about not falling for the trap. It's about shifting your mindset from a speculator to a strategic accumulator. The real opportunity isn't chasing this peak. It will come after the trap springs. First, your superpower is patience. You have to resist the urge to FOMO in. Chasing a vertical price chart is a loser's game. You must have the discipline to sit on your hands while it feels like everyone else is getting rich on paper. It's one of the hardest things to do in investing, but it's also one of the most profitable. Let the washout happen. Let the euphoria turn to despair. Your time to act will come. Second, you have to learn the difference between price and value. The long-term value of gold and silver as monetary insurance is climbing steadily as currencies get devalued. The price is what you pay today, and it's swinging wildly based on hype. The goal is to accumulate long-term value at a favorable price. Paying top dollar at the peak of a frenzy is not a good price. Buying that same ounce after a market panic is a much, much better deal. Don't let the price distract you from the value. Third, watch the right indicators. Stop listening to the hype. Start watching for signs that the trap has sprung and a real buying opportunity is here. What should you look for? First, a washout, a sharp, painful price drop that cleans out all the speculators. You're looking for a move so violent, the narrative changes from buy the dip to it's over. Second, you want to see sentiment reverse. The headlines should turn pessimistic. You're looking for fear and despair. The old saying is true, the time to buy is when there's blood in the streets. And critically, watch what the central banks do during a price dip. Do they panic sell with everyone else, or do they use it as an opportunity to buy even more? Their actions will tell you everything you need to know about their long-term conviction. Finally, let's talk about allocation. And let me be clear, this is not financial advice, but a strategic framework. For many, a core position in physical gold of maybe 8% to 12% of a portfolio serves as long term insurance against systemic risk. My warning today isn't about that core position. It's about making a new, oversized bet at the absolute peak of a euphoric rally. That's not investing, it's gambling. The strategy right now is to protect your capital and wait for the inevitable sale. Wait for the moment of maximum pessimism. That is when you can add to your position with a much higher margin of safety. What are your thoughts? Is this the biggest bull trap in a decade, or is this time truly different? I really want to hear what you think, so let me know in the comments below. And if you haven't already, subscribe for more analysis that cuts through the mainstream hype. It's more important now than ever. Watch the video on your screen next for a deeper dive into the forces shaping these markets. Stay vigilant and stay informed.